Hello, it's Robert Miner with Dynamic Traders Group with this week's short video, trade tutorial video and analysis video on a couple of markets that we look at frequently with our YouTube subscribers and Twitter followers. We're going to look at the S&P and we're going to look at the dollar. We've done lots of videos on these. I didn't do a video last week. 2 weeks ago I did it on the euro dollar. So we'll update that. We'll update the S&P. And I really want to focus on trade strategies. A lot of people out there that haven't traded before, they want to learn how to trade. They think it's about forecasting the future. It's not. Traders don't forecast. They identify conditions with a high probability outcome, and then they identify the specific trade strategies to take advantage of that information. That's what we're going to look at here on these two markets. So, that in mind, if you like what you learn, come back week after week, subscribe so you can get notified when a new video comes up. Also, go to dynamictraders.com and check out our Traders News. You can become a member of that. We don't need a credit card. We don't need anything. Just your email address so we can let you know when we put an update up. So you can get more updates and more trade strategies and more education for no charge whatsoever. So that said, let's get started. This is a screenshot from the last video I did, which was on the dollar and the euro. This is a screenshot from that video right near the end of the video, after we went through all the explanation on why more than likely the dollar was making a correction. The ideal target zone for that correction was these, about 108.57, 56 to 108.26. That was the 100% alternate price projections of the two prior swings. It had a potential for making an A, B, C, D, and then that would be ideally a wave E. And the instructions here was the dollar intermediate trade strategies. That's probably going to be short for the next 3 or 4 days. And that's because the daily momentum cycle had just made a bear reversal. Usually it's 3 or 4 days sideways to down at least before a daily low is made. And it instructed that at the end of next week, which would have been the week ending November 11th, see if the dollar is in a position to complete a low that should last several days to several weeks. So let's update this and see what occurred and where we are as of the end of last week, which would have been Friday the 18th, 2 weeks after this video was done. So this is the dollar weekly data, and this is the bar, boy, that was that CPI week. The bar of that week, that's the weekly bar. And boy, really nasty decline that week, wasn't it? A lot of people are going to get really bearish when you have an incredible decline like that in a week. It went right through the ideal price target zones for a wave A. No big deal. It doesn't void that this decline off the September high is probably a correction. It doesn't void that that decline was near the probable end of that correction, or at the least nearing a weekly reversal, making a low that lasts a week. When I call it a weekly reversal, that's a weekly cycle, usually then reverses in the opposite direction for at least 3 to 4 weeks. So that's a trade setup, a really great trade setup. In this case, that's the potential for completing a correction, which would be followed by a new high. Well, let's take a look as of the end of this week. It's a strong week down, closed at the low of the week. It has driven the weekly momentum cycles to oversold. So that's giving us a warning that the downside is probably pretty limited before a weekly low is complete. These weekly, momentum cycles for any time period are a really valuable tool to have, particularly when you use dual and triple time frame momentum position. So let's update this as of the end of this past week, which was the 18th. Well, first what I'll do, let's go to the daily data as of that time. This is November 11th, so that's that weekly bar, that Thursday and Friday, boy, big down days. That's the CPI day, and that's the day following it. So there's been no setup. There's been no setup, no trade strategy to enter long. We haven't had any kind of a reversal. But we do know, as of the end of that week, the weekly momentum cycle is oversold. We're near a weekly low. And the daily momentum cycle is what we call dual look back oversold. But we still need a reversal in the momentum, the daily momentum, and then we need an actual trade setup. Let's update this data a few days. So I've added just a couple of bars onto this daily chart. And of course, we had a little inside day on the Monday, and then Tuesday, we did make a new low. We haven't closed higher yet. We didn't close higher above the prior day's close. But look at what's happened as of this day. Our daily momentum cycle has made a dual look back bull reversal, and it just happened to be on the fourth bar, the fourth day, that was dual look back oversold. And that's usually about the extreme before we get a price reversal. So now we can develop a specific trade strategy. So a trade strategy that I recommend is if a market is in a position to have completed a wave structure, or it's at significant time or price support, dual time frame momentum, whatever, a trade strategy is to, in this case, we're looking to go long, is, for instance, to buy on a higher close or buy if it takes out a little minor swing high, like this inside day swing high. So let's go go long on a higher close. Why would we not do that? Our higher time frame weekly momentum cycle is oversold. We have the potential for completing an ABCDE correction long on a higher close. That makes sense, doesn't it? Are we making a reversal or not making a reversal? Where would your stop be if the market closed higher, let's say in the next day? We don't know if it's going to, and we went long. Well, it's really simple. The stop goes no further than one tick below the low made prior to entry. That's your trade strategies. Really simple. It's all dependent on identifying if the market's in a position to make a reversal. And even if it exceeds some of your price or time targets, that doesn't void the position and the probability of that higher time frame reversal. Let's add some data onto this chart. We'll add just one bar here. I'll drag it over one bar. Didn't have a higher close. It was a lower close that day. You can see that the momentum cycle looks like it's turning around. And there we go. On the next day, that's a Thursday, the dollar closed higher. Let me just put on the close here. A long on the close, a stop no further than one tick below the low. So you could be trading the euro and the Forex. Maybe you're trading the ETF. Excuse me, not the euro, the dollar. So UUP is an ETF, an unleveraged way to participate in dollar trends. So you want to use this information to identify conditions with a high probability outcome and then specific trade strategies. So let's add another bar on. That's actually, that's the 18th, Friday. Yeah, that's yesterday. I'm recording this on Saturday, the 19th. Well, it's certainly not any great bull trend so far anyway. What happens if we get stopped out here? It'll be a small loss, a controlled loss as we see, an acceptable loss. No one likes to have losses, but sometimes we do and we trade. What if we were to get stopped out? Will we then give up? No, because nothing has voided that the dollar is in an extreme position from where a weekly low is made. So if we happen to get stopped out, as the way I put it to our subscribers is that should the dollar continue lower, the downside should be limited before that weekly low is complete. So we want to take any advantage that the market gives us with a trade setup with acceptable capital exposure to position on the long side for a potential multi-week advance and potentially even to exceed the September high. So you see the trade strategies are really important. It's not forecasting. A market can exceed your price targets that would be ideal for a particular wave structure. It can exceed the time targets, but those don't void the larger position of the market, and that in this case, it's still in a position to complete a weekly low. So That's where we're left as of the end of the last week with a long position with a stop not too far below the market. If stopped out next week, I would immediately develop a trade strategy, and I usually base it on, once we get ready to enter a trade, on the daily momentum cycles to, again, position on the long side. Let's take a look at the S&P. Well, here's a couple charts of the SPX, and these are charts I put up on Twitter. This first one, it's a daily chart. It was put up on Thursday, November 10th. And it just had a lot of information on this chart, but here's the bottom line. A corrective high due by November 17th, and ideally by November 14th. So the 15th to the 17th, and as well as Monday the 14th, all had some significant time factors that had the potential to complete a corrective rally for reasons we don't have time to go into here. Then I updated that on the following week because no reversal signal had been made, no trade signal had been made until we get to the following week on Wednesday, almost a week later. So here we are again, it's between the 14th and the 17th, 15th to 17th have two key time factors, and we're looking for a corrective high. Well, here's what happened as of Wednesday the 16th. Is the daily momentum cycle reached dual look back overbought, and on that Wednesday, the daily momentum cycle made a bear reversal, set it up for a potential trade setup. And you can see I have a little Elliott Wave count in here, 1, 2, 3, 4, 5, with a question mark. It's not confirmed, but we knew that the market had come right up into the probable extreme price target to complete a corrective high. And right within the time target, we know that the weekly momentum is overbought and the daily momentum's made a dual look back bear reversal. That's almost the ideal setup. So that doesn't mean you go short right away, but you can go short or get in a bear inverse ETF fund on the next lower daily close. That's one of the trade strategies. So let's look at the data up through the end of this week. So we got a few more days on the chart. So this again is daily data, and this has one additional bar on that chart, and this would be Thursday. The SPX closed lower. So if you want to go short the SPY, go short the ES, so you can look at some of the other indexes. You can do it leveraged, you can do it unleveraged. And we know that the weekly momentum was overbought. We know the daily momentum's made dual look-back bear reversals. We know it was in a time zone and a price zone that had the potential to complete this corrective rally, which would be a wave C. So short on the close, where's your stop? The stop's no further than a tick above the high made prior to entry. So let me just put those two prices in. And that was just Thursday, a couple of days ago. Let me just clean this up a little bit. So that Friday closed up on the day. So may get stopped out of this. So let me ask you, if we were to get stopped out of this trade, what does that mean? Does that mean that that's a bull trend? It's gone to a new high? More than likely, no. Nothing has changed that this market is near the extreme from where a corrective rally should be made. So remember, my friends, you want to learn to trade, not forecast. So subscribe below if you like what you learned here so you get notified whenever we have another update, and go to dynamictraders.com and sign up for our Traders News. That's it for today. Take care. Robert Miner over and out. Hope to see you next week once again.